Okay, let's get to the first idea. National Bank of Canada would be among your favorite lenders.
If you're worrying about mortgages, the National Bank is your bank, because house prices in Quebec are just not like house prices in Toronto or Vancouver, quite different. And that's where most of their mortgage book is, and that's where most of their retail banking business is. So National Bank is, as a result, much less exposed, very prudent bank. They probably had the best results of any of the banks last quarter, any of the Canadian banks. We think well run. We've had a great history with them, very happy. And all the Canadian banks right now are cheap. They're low price earnings multiples, high dividends. They're pricing in not disaster, but they're pricing in bad news. I think the chances of National Bank in particular and the Canadian banks in general of cutting their dividends is close to nil. So at the worst, you're going to get the dividend. And at best, you may get a nice bump if the price earnings multiple bumps back up to like 12.5 times.
Right. So that's interesting. Exposed, though, famously to the capital markets, National Bank.
Yep, they have a big capital markets business, but they seem to do well at it.
Granite REIT, originally a spin-off out of Magna, but a warehouse REIT.
That's correct, and it's industrial space. And I think when they spun out of Magna, 80% of their book was former Magna properties. It's now down to less than 50%. They've done a lot of acquisitions. Unlike a lot of REITs, they're not highly levered. Only 33% of their balance sheet is leverage, whereas most of the REITs that we see in Canada are 60% or even 65%. So much less exposed to high interest rates than their competitors. And unlike some of the other REITs, very little exposure to commercial office towers. Wholesale warehouse space right now is at a premium. People want it, and the prices are very high. So it surprises us that Granite has not, the stock price hasn't taken off more. I think it's lumped in with the other REITs. People don't distinguish its business from what the other REITs are doing. So it's not surprising to me that a lot of analysts see it as a strong buy. We think it's very cheap and a good play, not only for income seekers, but also there's some growth there.
Is there a risk, though, that too many warehouses have been built? I mean, in the sense that Amazon overinvested. Do you think there could have been euphoria among other companies as well?
Possibly. Although, the growth of manufacturing in both Canada and the United States demands more space. And a lot of the warehouse space, and I just learned this from a manufacturer I was talking to, a lot of the old warehouses have 14 and 18-foot ceilings. New warehouses are being built with 30 and 60-foot ceilings.
Whoa.
Because of robotics and the ability to
stack stuff
up to the sky. So some of the old warehouses are going to get retired.
That's interesting. Yeah. I guess a human forklift operator, well, they're not going to be able to go 30 feet up.
Or 60, yeah.
Yes. Finally, fast food, or junk food to its critics, restaurant brands.
Popeyes, Burger King, and Tim Hortons. I think in Canada, we're very sensitive to Tim Hortons. And everybody listening today knows that Tim Hortons was very badly run after it was acquired by Restaurant Brands. They just didn't get it. They didn't get the cultural aspects. They didn't get the iconic significance.
And the franchisee relations.
Oh, terrible.
Yeah.
So there's a new sheriff in town, Patrick Doyle, came over from Domino's, where he engineered a fabulous turnaround, did great at Domino's, was lured into Restaurant Brands by a option share package fit for the gods.
2 million options plus restricted shares, you name it.
If he succeeds at Restaurant Brands, he has the possibility of becoming a billionaire. We hope he does, because if he succeeds, we'll succeed as well. We think there's tremendous opportunity in this one. People have disliked it for a long time because they haven't run the franchises very well. There's a huge ad campaign going on at Burger King. They've made good changes at Tim Hortons. There seems to be a Popeyes opening up on every street corner once a week. It's just astonishing how fast that chain has grown. So we were owners of Domino's when Doyle was running it and benefited tremendously from that. We are gambling on him as being a moving force and turning this thing around, and we think there's a big upside.
My objection to fast food, in a way, is it's boring because you get the same darn chains everywhere. It's kind of Stalinist that way.
Well, I suppose it is. And a lot of them are owned by the same hedge fund, by the way. Owns about 12 of them. I can't remember the name of the hedge fund, but owns a lot of them. The hedge funds and people like the owners buy these because they're steady.
Yeah.
They keep, it's good, solid income, and there is leverage. So the other thing I would say about Restaurant Brands, it's trading at about 2/3 of the multiple of the other fast food chains.
Oh.
If you look at McDonald's or PepsiCo or some of the other ones that are public, this one looks conspicuously cheap because of the problems they've had in the past. So if you believe that Doyle is worth all that money, then this is one you should buy.
Yeah, interesting. What about the restaurant business itself, of course, has been, high costs, higher labor costs?
Higher labor costs for sure for the lowest paid wages, now $15 minimum wage in the United States, up considerably. But it's a high margin business, it seems like you're not paying very much, but compared to what it costs, you're buying your Diet Coke for $1.50, and it costs them 15 cents
if that.
to pump it out of the dispenser.
Yeah.
So they're making their money, and recession resistant, and as I say, we think very well placed against its competitors. So it's I wouldn't quite call it a turnaround story, but it's a make it better story. How's that?
I would just rather see family diners, restaurants, independently owned restaurants. But of course, I'm stuck in the past.
Well, that's a segment. And right now, in the post-COVID era, there's no question people are spending a lot of money dining out.
Oh, yeah. It's a bill. I can't believe it. Yeah.
Yeah, and it's a pretty expensive proposition.
First idea, Marvel Technology, a chip company, but with an AI angle here.
Yep. So currently trading right around $59. Runway isn't all that long. Here it is, 61. We have a 12-month price target of 68. We're still holding on. Together with the subsidiaries and so on, it provides data infrastructure, semiconductor solutions. It has, the company's revenue is projected to grow at an average annual rate of 18.5% over the next 5 years. But it also has a forecasted net margin of 8.6%. And its valuation, based on a discounted cash flow valuation approach, yields a price target of actually $79. So we're a little bit lower than that, but $79 really gives it a more than 30% runway going forward. So we like it. We're trying to hold in there. You can buy it in here, maybe on a pullback down around 56 and then 53.
Your next idea is Microsoft, and it has won that court decision in America approving the Activision takeover, although apparently Britain is still holding out, and apparently it still has regulatory hurdles in America, so it's not a done deal yet.
And I'm actually sort of live, and you can see all the analysts, changing in their price targets. So currently trading around 330. Microsoft, amazingly, still has a very decent runway ahead of it, about 375. And, people, the probability of actually getting Activision is just going to add to everything else that it has on the cloud side and the Office 360 and so on. So this is a core holding in your portfolio.
And they are a major player in generative AI.
Absolutely. They're the ones that, everyone talks about OpenAI, that they put in $10 billion, but that's the third time they've actually invested in OpenAI. Now they have ChatGPT embedded into their APIs in their cloud business of Azure.
Sorry, what's API again?
So it's just the link to actually get in and be able to, the runway into it. And so now in the cloud, they have all these modules that use ChatGPT that just accelerates the intuition of how to help run more effectively and efficiently a business.
And of course, businesses are overwhelmed with data. All of us are overwhelmed. And
absolutely.
Will ChatGPT help filter some of that stuff?
Yeah. Andrew, when we were talking earlier, I don't know how many times I used ChatGPT 4 every day. But when you ask them a question, then the next question I always ask them is, can you please just summarize it? And then boom, it happens just like that.
Yeah, it's the era of TMI, I think. Yeah. And finally, meta platforms.
Yeah. So isn't it funny, Facebook, Meta, a year ago was the one that no one would touch.
Yes, yeah.
And then they decided to just hold back a little bit on the metaverse and so on. But this is an interesting play because you can see the theme here on the AI. If you look at Microsoft sort of has a closed AI with ChatGPT. Meta has actually used open source, so everyone can actually build on the stack. And it's a very, very different approach to actually accessing artificial intelligence. A lot of the developers like the Meta open source side. So anyway, currently trading Meta 291, and we have a 12-month price target of 320.
And just very quickly, there was a feeling that Zuckerberg was pouring money into virtual reality, and a fear that he was investing too much.
With the Quest, with the goggles, right? And that's actually worked out very well. When Apple came out with the Vision Pro,
much more expensive.
8 times more expensive. And then, that sort of diverted the attention over into the Quest. And now, on top of that, you have Meta, who now has Threads, and they have more than 100 million subscribers in 1 week.
To the Twitter, their rival to Twitter.
Versus Twitter, that has 240. So they're almost halfway there in 1 week. Amazing, eh?
It really has been just the speed of change in that tech sector.
Absolutely.
Yeah. Kim, we better jump. Thank you very much indeed for joining us. Kim Bolton. First top pick is Chevron.
This is a company that we bought earlier this year. Obviously, energy is very much out of favor. Chevron made a lot of capital investments back in about 10 years ago, from the period 2011 through, say, 15, and they're really paying off. They're in a very strong financial position, 11% debt to total capital, so it's a very, very strong balance sheet. They have a great free cash flow. They trade at 7 times enterprise value to EBITDA, so they're relatively cheap. And we just think there's wonderful promise with this company, not only on a growth basis, but also on a shareholder-friendly payback basis. So they buy back shares. They've got a very fine dividend of close to 4%. Lot to like with Chevron, Andy.
Okay, and why would you prefer them over Exxon, for example?
We always do peer group analysis when we buy companies, and yes, we felt that they were in a stronger position. Exxon has a very strong natural gas area that they bought. I think the timing was a little bit poor for them, but it might prove to be okay. Chevron also has some natural gas exposure, but it's a much more balanced, fully integrated system. Exxon is as well, but we prefer Chevron on the fundamental basis and the organic growth and on the valuation level.
JP Morgan Chase.
Yeah, the banks have had a tough time, and we think that as the air clears, as the Fed starts to finish up their tightening process, as the market either understands that we're going to have a soft landing and either a very mild recession or no recession, or even if we have a recession that takes a little bit more of a bite, they end. And when they end, financials are a great place to be. And the financials have never been in a better financial position than they are today, partly because of regulation, but also because of just good stewardship. JP Morgan, for example, trading at 9 times earnings. Historically, the banks have traded around 13 times earnings, so there's quite a discount there. It's not a cheap situation, but they are the cream of the crop. They're trading at about 2 times tangible book, which isn't inexpensive, but you get a lot for what you pay for. When SVB, Silicon Valley Bank, went bankrupt in early March, they were the bank that came through and bought the assets. And, you know, they buy them at a discount because they can. And we continue to like this particular bank.
Maybe we could just quickly pop up the 5-year chart for JP Morgan's. It's off its highs of late 2021. It's almost like, looks almost like a tech stock there, doesn't it? Peaking late 2021, big rally lately.
Yeah, and the rally lately is because the market is seeing the end of the tightening process, and that is very good for banks. If we get into a more normalized yield curve slope, so lower rates to higher rates, that's very beneficial to banks. That's how they make their money. We've also seen an IPO market and a capital market that has been really on its back for, 18 months, and that's temporary. We know that there are a lot of companies, because we're in a relatively strong economy, there's a lot of companies that want to do deals, they want to do mergers, they want to go public, but they've been held back largely because of confidence. And when they do go public and when they do finally pull the trigger on those mergers, JP Morgan is going to be in the mix.
And then finally, WEX, which I believe is a provider of software and services to fleets, for fleet management.
That's most of their business. About 60% of their business is fleet management. So think of a trucking company, and you've got drivers out there, and they have to get gas, and they have to get the oil changed, and you want to know exactly how fast they're driving and how efficiently they're driving.
If they're taking any detours.
Well, could be. And what WEX does is 4 large trucking companies controls the spend and the analytics. So the driver doesn't have to worry about putting in expense reports. He's going to pay for the gas. It's on the WEX platform, so it makes it much more efficient and controllable.
And they say whatever is measured improves.
Well, there's a lot to be said for having control of your business, and WEX has been able to put together a business that is growing organically at really nice rates, like 14, 15, 16% a year, yet the stock's trading at about 13 times earnings. It's not a well-known stock, and it's one of those that we think, you know, a little hidden in the weeds, and you can take advantage of it at this point.
Gordon, thank you very much indeed.
Thanks, Andy.
First idea, as advertised, Chubb, the insurer.
That's right. So Chubb is a property and casualty insurer, very global. About 40% of their their premiums come from outside of the United States. So they have very deep product offering. They do personal lines, commercial, accident and health, reinsurance. So lots of very deep offerings, and they will grow through acquisition as well. They actually made an acquisition in Asia in the life insurance space. But why we like Chubb, you know, it's pulled back, very attractive valuation at about 10 times forward earnings. And this company has a very disciplined underwriting process. And what I mean by that, Andy, is that, you know, when they decide the premiums they're going to charge you when they provide insurance, it's very well researched, they make sure that it covers its costs. It's like some insurance companies, you know, they pay out more than what they charge, because you never know when you buy an insurance policy if you're going to actually eventually pay out. So they take those funds and they invest that. So their underwriting discipline is very good. So their combined ratio is consistently below 90%. And as well, in terms of their investment portfolio, it's about 87% in fixed income and bonds. So rising interest rates actually is a tailwind for Chubb in terms of their investment portfolio, because as bonds mature, they can reinvest at higher rates, and they're seeing that. The current yield in their portfolio, I think, is around, they said, 3.5%, but they're reinvesting at about 5.5%. So it's the returns on that investment portfolio will increase over time as you know, maturities come due. And so it's a conservative investment strategy, and very high quality portfolio, and as well, very well respected management team.
Your next idea, Thermo Fisher Scientific.
So they provide tools, products, and services to the healthcare industry. So they provide anything that they can bring, help biotech companies go through clinical trials, provide materials and equipment to manufacture the drugs, also even outsource those processes for drug companies. So they work with all sorts of healthcare companies, hospitals. They can provide everything one needs to run a lab. And so this company benefited quite a bit during COVID because they also have a diagnostic division that diagnoses diseases. So during COVID, they made lots of money. So, obviously the tailwind from that is now a headwind. So the earnings per share on this company actually went down a bit last year because of the comparison, and it's going to be flattish this year, but we see growth picking up again. And meanwhile, the company was able to use all that cash flow they generated from COVID testing and kits to reinvest in their existing business, develop new products, as well as make acquisitions. And they're fairly confident now. They've kind of raised their growth targets to 7 to 9% annually on the top line. And they also have a very effective continuous improvement process to improve margins in their existing business, as well as business they acquired to improve the margins on that business. So about 82% is reoccurring. It's consumables and service, so that's kind of a defensive characteristic of their revenue profile as well.
And finally, Visa.
Yeah, so we all know Visa, global payments company. Stock has done well, has participated in this rally, but we think that Visa has, whether the consumer buys goods or services, it benefits Visa because it's still money coming, through their system. They're the largest. So in that whole global payments area, we talked about PayPal earlier. We have chosen Visa over MasterCard. We've owned Visa for a number of years because they are by far much larger in terms of payments volume. And once again, it's that long-term secular growth trend of moving from cash and check to digital payments. Many countries around the world, cash is still the primary form of payment. So you have that transition coming. And as well as we know, as e-commerce growth continues, automatic beneficiary are companies like Visa when you're using your debit card or credit card to pay for goods.
Yeah, it's interesting. I know there's a bit of a movement in Britain, people asserting their right to use cash, saying we don't want to be tracked or...
Oh, I see. Okay.
And it can be hard, I suppose. Well, apparently, I think one of the arguments is that some older people have difficulty with all this online stuff and they want to use cash.
Yeah, it could be. But I know my kids, they don't even carry cash. When they want cash, they ask me for the cash. And then they'll e-transfer me the amount. That's a whole different mindset from generation to generation.
They're like royalty. They don't carry cash.
They think they're royalty.
Well, thanks very much, Christine.
Thanks, Andy.
Rick's first idea is called Mega Uranium, MGA, on the TSX.
I'm attracted to the uranium space in particular. I'm attracted to Mega as a value proposition. The market capitalization, or rather the enterprise value of Mega Uranium, is less than half of the current quoted value of their securities holdings in other uranium companies, in particular NextGen, which I'm also attracted to. Your risk here is that you will continue to receive, I think, a holding company discount. The good news is that the discount is way, way, way too extreme. You also run the risk of salaries at the Mega level and salaries at the NextGen level, which is to say your holding costs are fairly high. That being said, given the net present value of their portfolios, given the prospectivity of the assets that they have that aren't in the portfolios relative to the share price, this is a very, very, very cheap way to play the uranium game.
Your next idea has the Las Chispas mine in Sonora, Mexico, Silvercrest Metals.
The Silvercrest team has been pretty successful in discovering, developing, and then selling deposits. This deposit they put into production, and I think they were penalized for going into production by the sort of lag or the boring period in the Lassonde curve. They have now completed construction, and I suspect that as the mine begins to prove itself at nameplate capacity, that either the share price will trend up, or the stock will be taken over, either of which is good to me. This is too cheap given the quality of the assets and the quality of the people.
And then your final idea is origin royalties. It looks to me like they do enjoy early stage exploration projects. That's their specialty.
Yeah, I need to say with this pick, I like it a lot, but this is a very thin market capitalization, probably 95 million Canadian dollars. Do not compete with each other. If you're going to buy this, use good till cancel limit orders. Remember, this is really thin, small market cap, closely held. What I like about it is they have royalties on two projects, Silica Cap in Nevada, and Hermosillo in Mexico, both of which, Ermitaño, pardon me, both of which could easily be sold to other royalty companies for a combined sum that I think handily exceeds the current market cap of Origin royalties. And you get the basic business, the royalty generator business, the exploration business that generated the wealth to begin with, for free. One more time, however, this is closely held. There's a small market cap. If you're going to buy it, use a good till cancel limit order. Use caution. Don't jam this stock.
What about the big royalty players, the Franco-Nevada, Wheaton Precious? I know you pick and choose mining stocks. That's your métier. But do you have any? Would you ever own one of those royalty players?
I own both of them and have owned both of them for decades. I suspect that's how I play the beta myself in the gold mining business as opposed to the alpha. I honestly suspect, Andrew, that the sell decision on both Franco and Wheaton will be made by my heirs, successors, and assigns.
Oh my goodness! Well, that'll be a lot. That'll be decades in the future, Rick. You feel that you've confidence in the long-term management of those two, clearly.
Yeah, and also the asset quality. They got in the game when most of their competitors were doing other things, and the consequence is that they have royalty and streams over very large long-term assets. And that's a benefit. Great, big, huge deposits, giant deposits, always yield you surprises, and they're almost always good surprises. Meanwhile, at least in the royalty business, in effect, your gross is your net. These companies commonly enjoy 90% operating royalties, and their general and administrative expense, because they aren't miners, is very low compared to the mining company averages. These are truly, truly unique businesses. Probably not suited to traders, very, very suited to investors.
It is interesting. They have fantastically small staffs. That's right. I have to, before we let you go, and we've only got about 45 seconds, if you had to pick between Newmont and Barrick these days with a 5-year time horizon, would you have a strong preference, Rick?
I personally would choose Barrick because I like their fondness for great big mines. I like Newmont. I like the leverage in Newmont. I'm concerned with Newmont that there are too many two-tier assets. I like the fact that Newmont has acquired Newcrest. I think that those amalgamations are good. But since you asked me the question directly, I personally would put Barrick over Newmont.
Thank you. It's always a fascinating face-off between those two. Thank you very much indeed, Rick. It's always a pleasure and an honor to have you on the show, and always very informative. Thank you very much. Rick Rule.